Okay, so in the last video, we looked at how to add an inventory item, and at the end, we talked about the accounting, what's happening behind the scenes when we get that inventory in and when it leaves, that kind of miniature investment process. But let's see what it looks like actually on the reports using some expense forms and some sales forms and seeing what happens to the numbers here. Remember, this is showing our big number 1 here because that item is low or out of stock because we have 0 on hand. So let's change that. And let's get some in and then sell them off. And let's look at what's happening behind the scenes. Okay, so first thing, let's buy them. So let's go to +new and tell QuickBooks that we have purchased this inventory. Let's do an expense to supplier ABC. That's great. Let's say this was toward the beginning of the year. Let's say it was January 3rd. Okay, so category details is where we would put in like different like utilities or advertising, kind of those categories or expense accounts. In this case, we want to indicate that we are buying a specific item. Remember, the specific item that we have, that we hold in inventory. We buy this thing from our suppliers and then we sell the same thing out the door to our customers. So item details, make sure you're down here. Let's change this to ball cap. Okay, and so notice the SKU comes in, the description comes in, and the rate comes in here too. Let's say we're buying 100. Okay, so, oh, that's cool, look at that. Quantity on hand says 0, and the reorder point is 50. So that's helpful to say, hey, I should probably order more than 50. So let's just say for this case, we're gonna buy 100 hats. Okay, so it's gonna cost me $1,600. Let's see if this little investment pays off. Okay, so save and close. We just told QuickBooks that we increased our inventory, right? We paid with cash out of our bank account, and we are increasing our inventory. So let me save this. And let's just take a look at what's happening here. We can go to the journal. And here we're going to see that the rule, right? At least 2 accounts are affected, and the 2 sides match. In this case, 2 accounts are checking and inventory, and the 2 sides match. Okay, I know they're going in different directions. Our checking account goes down and inventory goes up. So that's kind of what we're looking at here when we're talking about the double entry accounting. Okay, now let's go into sell those hats. Okay, we just brought in 100 hats and let's go sell them now. Let's go ahead and make an invoice for a customer. Let's say customer ABC. And this is also back on that same date. Let's January 3rd. That is just fine. Okay. Hey, look at there, product and service. So this is why we have to make sure all of our products and services are correct, because that's what shows up here on the invoices. In this case, we are selling those ball caps, and same deal, stuff automatically populates here. In this case, it's selling for 24. We bought it for 16, and we're gonna sell it for 24. And we're gonna sell 100, so we can see how many we have on hand. And what the reorder point is, again, that's kind of handy, huh? Okay, so 100. Okay, so there's an invoice for $2,400. So I'll save that and we'll stay here and let's see what's happening. So once again, at least 2 accounts are affected and the 2 sides match. In this case, we see 4 different accounts really affected, but the 2 sides still match. What exactly is happening here? See, this is where it kind of gets complicated with the inventory bit. Okay. Let's take a look here. I'm going to skip this top one because that's kind of where we're going to finish actually in this description. So we can see that retail sales revenue, right? That's our 4,000 series, increased by $2,400. That's awesome. Our inventory went down by $1,600. That's what we put in, and we incurred an expense. So with this one invoice, we have revenue, an expense, crazy, huh? Inventory, we're telling inventory to go down. And then the difference is found back up here in accounts receivable. Notice how the inventory and cost of goods sold match perfectly. And then the revenue and yet another asset account, accounts receivable, also matches. So what does this mean? Our investment example. Okay, we invested $1,600 to get a different kind of asset. And then we sold that asset to then bring in essentially $2,400. Now, according to this right here, it's not cash yet. It's sitting in accounts receivable for us to collect payment on from our customer to then deposit to the bank. Okay, that's all part of the revenue process. We'll get there. But you can see it will eventually, or most probably, become cash in the near future. $1,600 became $2,400. That's the whole idea. It's a little miniature investment. Okay, so there's that. I hope that's helpful and not too wonky, but I think it is useful to really understand, because especially with this inventory deal, it can get confusing and it's hard to figure out what's going on. Especially, I mean, even just the one idea of incurring an expense at the time of a sale, that's kind of out there a little bit. But once you understand it, it makes sense, and you can see, especially with that investment example, that's how it is, and it kind of makes sense. But it's important to understand what's going on, to not be confused with what's happening on our financial reports.